Hello everyone, I hope you guys are doing well and studies going in full swing. Now in today's video, we will be discussing and solving in detail the CA final May 24 exam question which the institute has solved in 3 different ways. We will discuss each of those alternatives and also discuss what needs to be done from an exam perspective. So over here, we have I've solved this in a much more simplified and an understandable format. So I'll share this board notes on your Telegram channel as well, in case you just want to quickly go through the notes in the format that we usually do. And secondly, in case you're looking for any new adjustments, well, this question is kind of exactly similar to the question 33. If you have done this earlier from the notes, question number 33. So if you have done this, we had WHNO. This is H, S and A, you will see exactly the same adjustments, just that there will be different variations or assumptions institute has used in terms of dividend, as well as in the exam question there was a capital reserve in associate. So you can jump to the end of the video where we are discussing these alternative treatments in case you have done this question earlier and you just want to see the alternative treatments for dividend. The treatment done in the traditional way of dividend not being paid is also done by the institute as the main solution. So what we'll do is we'll discuss this afresh and let's get started. Okay, so there is question number 1. The accountant Mr. Ramesh Khanna of H Limited submitted to you the following standalone balance sheets as on 31st March 24. So you have the balance sheet for H, S and A. Usual data like PP, investments, 14,000 shares in S and 4,000 shares in A. Current assets, inventories, etc. is given, and you have on the equity and liability side share capital, reserves, retained earnings, etc. Now the following additional information is made available in respect of these companies. H purchased the shares in S on 31st October 2023. So that is after I think 7 months, when the retained earnings of S was 5 lakhs and shares in A were acquired on 30th June 23 when the retained earnings stood at around 1 lakh 75. So you have been given retained earnings exactly as on the date of acquisition, and you have been given the dates of acquisition. Now if you want to find the stake, this is 14,000 shares and this is out of a total share capital of 2 lakhs, that is around 20,000 shares, and this is 1 lakh, so this is around 10,000 shares. So if I were to take the percentage, 14,000 out of 20,000 will come to around 70% stake, and hence for in S I have a 70% stake, so this is like a subsidiary, whereas in A this is 4,000 shares out of 10,000, so this is a 40% stake, and hence this is an associate, simplistically. Okay. So this is pertaining to adjustments for S as well as adjustments for A, where you have the retained earnings. Inventory of A as on 31st March 2024 included inventory valued at 60,000 which had been purchased from H. Now A over here is an associate, and this is inventory of A including some stock which it has purchased from H. So this is downstream, and this will impact A when we do analysis of A along with H. As on 1st January at cost plus 20%. Okay, trade payables of H included 25,000 again payable to A, the amount receivable being recorded in receivables of A. Again, this is intercompany adjustments for associate. Remember, in case of associate, we do equity method of accounting, and under the equity method of accounting, you will take over the share of the profits of the associate, and hence if there is any unrealized profits or losses, you will eliminate the same, but you will not take over assets and liabilities of the associate. So there is no intercompany elimination for receivables and payables. Goodwill in respect of acquisition of S. Now S was a subsidiary, has been fully impaired, so you will have to write off the goodwill. This is pertaining to S. The recoverable amount of investment in A exceeds its carrying value as on 31st March 2004, and hence in the SFS there will be no further write off, but in CFS goodwill will have to be written off. So you will have to first calculate the goodwill and then write it off. Non-controlling interests are valued at proportionate share of identifiable net assets. So the goodwill is partial goodwill, and you calculate NCI using proportionate net assets method. Okay, then this is the adjustment for which institute has given 3 alternative solutions. The first solution is the standard solution, and then we have 2 other alternatives which we would want to discuss. 10% dividends were declared by both H and S, whereas A Limited declared a 15% dividend for 23-24. Now you have not been given when these dividends were declared. You can assume that they were declared after the year end because it pertains to the year 23-24. So they must be declared after the year end and paid after the year end, in which case there will be no impact of this adjustment in your solution, because if it is declared after the year end, the liability, the asset, everything will come in the next year and hence no impact in the current year. However, if you assume that they have been declared before the year end, then there will be certain adjustments which we will additionally do. Okay. On 31st March 2024, that is at the last day, S made a bonus issue of 1 equity share for every 2 shares held by the shareholders of S. Okay, so this is a bonus issue made at the end of the year. Now, is the effect for this given or not? We'll have to see. Dividends were declared but were not accounted by all of these companies in the books before the year end. So, they have been told that they were not accounted in the books. Similarly, the bonus issue of S was also not reflected in the balance sheet of 31st March 2024. So we'll have to see what is to be done with dividend and bonus over here. You are required to take note of the above available information and draw the consolidated balance sheet as on 31st March 24. Notes to accounts are not required. We have prepared the notes in our solution, though the institute has to not required, so we can do the working directly as well. So first of all, what we will try to do is we'll try to find the stake. However, while finding the stake, one needs to be mindful that there is a bonus issue as well. However, the bonus has not been accounted. So when we look at this 1 lakh over here, this will be pre-bonus, as well as when we look at these 4,000 shares that were acquired and these 14,000 shares that were acquired, these 14,000 shares, let us say, of H were also shares which are, let us say, considered to be our shares acquired which were pre-bonus. Now, I can sit and calculate the stake. Like for H, I can say that we can sit and calculate the stake over here. So the stake of H in S can be calculated pre-bonus. Let us say there was no entry for bonus passed as we did earlier, as 14,000 by 20,000 gives you a 70% stake and hence H is a subsidiary. But one can always argue that, well, we acquired a stake in H and then there was a bonus issue. So H ideally in their S ideally in their individual books should record an entry for a bonus. If it is not passed, well, we will pass the entry. So what will be the entry over here? We will say over here, if there is a bonus in the ratio of 1 share for every 2 shares held, which means against 20,000 shares you will issue 10,000 shares, that is 1 lakh rupees will be the bonus. So your entry will be reserves account debit to share capital unless given otherwise. We will assume that the bonus comes out of pre-acquisition reserve. So if you had to pass an adjusting entry, this would be retained earnings to share capital, assuming it is out of pre-reserves, and post bonus the number of shares would be 14,000 plus, let us say, 7,000, that is equal to 21,000, and in the denominator 20,000 plus 10,000, that is 30,000. My stake remains 70% only and 30% will be attributable to NCI. Now institute over here has said, and rightly so, that bonus is just an entry where you are debiting the shareholders, that is reserves, and crediting also the shareholders, that is reserves, and hence it does not really change your net worth or net assets, and hence the bonus can be ignored. We can ignore this if the bonus is out of pre-acquisition reserves. We have assumed that the bonus is out of pre-acquisition reserves, and hence the institute has in its solution ignored the impact of bonus, because if your pre-acquisition reserves fall and then your share capital rises, your ultimate impact gets nullified. Everything, your net worth falls because the reserves are falling, but your share capital increases and hence the effect gets nullified. So your stake continues to be at 70% only. But when you look at A, there is no bonus over here. 4,000 by 10,000, that is 40% and hence associate. So we are now clear that there is a subsidiary and then there is an associate. The usual steps that we follow is we will prepare the schedule 3 format. Over here I have prepared the full format with the solution as well, but we will prepare the schedule 3 format which is blank based on the data in the question. Then you write down the notes, and in the notes, I mean, here you are not asked to prepare the notes, we can do that directly, but nevertheless if you are asked to prepare the notes, you will note down all assets, all liabilities in this except for the share capital, which of the parent you will show separately. Then you will have 5 items rather which are remaining: the reserves of the parent and the subsidiary, the investment and the share capital of the parent which you have taken, and the subsidiary share capital you will take. So over here we will start with the working note number 1, which is consolidated retained earnings. We will start with the standalone parent, which is 9 lakhs, which will come over here as it is. Then we will go to the analysis. We can analyze the subsidiary and the associate separately. So first we will go to the subsidiary analysis, where we will start with the investment. So over here, let us say you will have the investment which is 5,60,000. From this you will subtract the share in the pre-acquisition net worth. Over here we are ignoring the bonus issue, and hence whatever is the share capital, which is, let us say, 2 lakhs, into 70%, that is 1,40,000 is attributable to the parent. Because NCI is using proportionate net assets, we can say that another 30% is attributable to the NCI, that is 60,000. Now what we are left with after doing all of this is your reserves of the subsidiary. So when you look at 7,50,000, a part of this 7,50,000 is attributable to the pre-acquisition reserves, which over here seems to be 5 lakhs, and hence the remaining 2,50,000 is attributable post-acquisition. So when we do the analysis of reserves, the thing about dividend over here is that we told that 10% dividend shall be declared by X as well as X, and 15% declared by X as well as. So when you look at X, it seems to have declared a 15% dividend. Sorry, 10% dividend. 10% dividend we are assuming is going to be declared after the year end. That is the first assumption we need to be taken, and it will be declared after the year end. There will be no, that is the main function which will be a first assumption is ignore adjustment for dividend completely, as dividend has to be approved in the AGM, and then it will be at the goodwill workings, because this is parent share in the pre-acquisition profit, that is working out number is 3,50,000 goes over here, whereas for NCI both 1,50,000 and 75,000 will go in the non-controlling interest, and hence both of them are taken over here, and 1,75,000 will be the parent share in the post-acquisition profits, will be consolidated in the post-acquisition section over here in the retained earnings. So that will give you your total profits. Now this will take care of all the workings for our subsidiary. Therefore, we will try to total up and find 2,85,000 as a non-controlling interest, and then we will try to find a goodwill. So 5,60,000 is our investment for a 70% stake, and 4,90,000 is our share. That is 70% of the net worth or the net assets as on the acquisition date, and hence 70,000 will be the goodwill. Now the thing is, the goodwill is to be impaired because this is partial goodwill. The entire impairment will be taken up by the parent, and hence the entry will be consolidated retained earnings account debit to goodwill. So you will credit the goodwill, and hence your goodwill appearing in the balance sheet is going to be 0. However, you will debit the consolidated P&L, and hence less goodwill impairment of 70,000 will appear. Okay, now comes associate accounting. Now the thing over here is, when you take assets and liabilities, you will take over assets and liabilities of the parent and subsidiary, but for associate you will continue to show the investment. You will not take over the assets and liabilities. In fact, you will continue to show the investment. So the investment in associate will appear as it is. However, when you measure this investment, we will have to measure investment using equity method. That is, whatever is the share in the post acquisition profit of the associate will be added to the investment, and the second effect will go to the consolidated P&L. Other than that, assets and liabilities are not taken. Further, because our share in the profits are taken over, if there is any unrealized profit or unrealized gain, that will also be eliminated to the extent of our share. There will be no NCI over. Another interesting adjustment that you should be aware of under the equity method is, in case of investment, you will separately try to identify and disclose the goodwill, if any. Now, most of the sums in your study material have an implicit goodwill. However, there can also be a capital reserve. Well, yes, what happens in case of a capital reserve? Most of the times in the institute sums, you would not have done this. However, in case of capital reserve, as per para, we have mentioned over here, as per para 32 of Ind AS 28, if there is a goodwill, I just need to separately identify the goodwill. But if there is a capital reserve, I have to show the capital reserves directly, separately in other equity. You can refer para 32 of Ind AS 28, which mentions that your goodwill on acquisition needs to be separately disclosed. However, capital reserve needs to be recognized directly in equity, which means I have to bring in the capital reserve in my books of accounts. So I will credit the capital reserve, and I will have to debit something. I will debit the investment. So your adjusting entry over here, in cases of capital reserve, if any, will be investment account debit to the capital reserve, and this is what is applied in this particular question. So what we will try to do is, we will try to look at our investment in the associate. So your investment in the associate to start with is around 1 lakh rupees. Now you will take this investment as a starting point in your carrying value, which you have invested. At the same time, for goodwill workings, you will take that. So what we will do over here is, you will start with the cost of the investment, that is 1 lakh. This will be a part of my carrying value, and separately even for goodwill workings, you will take that the cost of the investment is 1 lakh. Now, for associate, we don't need to bother as much. We will just try to look at the profits, because other than that, assets and liabilities are not taken over. So for associates, if we go to see, the profits over here are 4,24,000, but on the date of acquisition, we had 1,75,000. So over here, if I take the difference between the two, 4,24,000 minus 175, which will come to, let us say, 2,49,000. So this will arise after the acquisition. So when we try to do the analysis of retained earnings, 1,75,000, closing is 424, so 249 is post the acquisition. Now the pre-acquisition data over here is only helpful in calculating the goodwill or capital reserve, but post acquisition, as per equity method, you will calculate your share on this investment. So this is 2,49,000 into 40%, that comes to 99,600. That is your share of the post acquisition profits. So have you received it as yet? No, and hence you will increase the carrying value, investment account debit. Second effect will go to the consolidated P&L. In subsidiary, we don't need to worry about this, because we directly take the effect in the consolidated P&L, because you are taking over assets and liabilities. Your assets and liabilities are not taken over. So if you credit the consolidated P&L, something has to be debited. So we will debit the investment. So for 99,600, your adjusting entry will be investment will be increased, and your consolidated retained earnings will also be increased. Investment in A to the consolidated earnings. Remember, we have mentioned that these entries are extra. You don't have to pass these entries, but for easier understanding and application, we have given you these entries. So investment is debited, and the consolidated retained earnings is also debited. So you can see your investment increasing by 99,600, and your consolidated retained earnings also increasing by 99,600. Now if you go to see in the question, there are a few adjustments. Point 1 is fully taken care of. Point 2 says inventory of A on 31st March includes inventory valued at 60,000, which has been purchased from H. So H has sold the inventory, so profit will be in the books of H at cost plus 20%. So this is, maybe if 60,000 is around 120, then 20 is equal to how much? So this is 60,000 into 20 divided by 120, and this comes to 10,000. Now 10,000 is the entire unrealized profit. What we have consolidated is only our share of the profit, and in the investment that is appearing is only to the extent of our share, and hence from this we will say into 40%, that is equal to 4,000, represents our share in the profit. So you will debit the consolidated P&L to eliminate the unrealized profit, and you will credit. Well, you don't take over the inventory of the associate, but this is appearing as a part of your overall investment in the associate, and hence the adjusting entry over here will be, you will remove the parent's share in the profit, that is 4,000, and the second effect over here will be against the associate's share of profit. So share in the unrealized downstream profit comes to around 4,000, and that over here will take care of all the adjustments for the purpose of calculation. However, we are yet to calculate the goodwill and capital reserve. So we will say that from the associate, 40% of the share capital is attributable to our share of the investment, and from these profits of 1,75,000, which was there pre the acquisition, 175 into 40%, that comes to around 70,000 will also be attributable, and as a result 40 and 70. So what I am paying is 1 lakh for getting a share which is worth 1,10,000, and hence there is a capital reserve of 10,000. Now as per para 32 to Ind AS 28, if there is a capital reserve, it has to be recognized directly in equity, not merely disclosed, recognized directly in equity, and hence we will credit the capital reserve and debit what, sir? We will have to debit the investment. So over here your investment is debited by 10,000. This is an important adjustment, and the second effect will be taken directly in the capital reserve. It will be shown separately as a part of other equity. This is 10,000 as a part of your capital reserve. So this is something that you should be aware of. Now that you have done everything, if you total up, you will see that the value of your investment is 2,05,600, which will appear in the final balance sheet, and there is a separate capital reserve appearing of around 10,000. Other than that, there is intercompany trade payables and receivables for an associate, which will not be eliminated because you don't take over the assets and liabilities of the associate, and that is about it. So once you take this, you will total up all the assets and liabilities, and you will take each of these respective numbers in the final balance sheet. Apart from that, you will total up the working notes, where your consolidated reserves will come to 11 lakh and 600 approximately. This is consolidated reserves, which you will add over here along with capital reserve to get 11,000, 10,600 for your other equity. Next, you will look at goodwill. Well, goodwill becomes nil, at least for the subsidiary, and NCI is at 2,85,000. So the three crucial numbers that you will take: other equity 11,10,600, NCI is 2,85,000. Goodwill technically becomes 0, but there's an investment in A which is appearing at 2,05,600. And after this, you will total up all the items, and with God's grace, your balance sheet should tally at 29,90,100. Now, this is something that we have discussed. I hope you would have tried this problem or done that question 33 from the material earlier. You should be seeing almost everything which is done and manageable. Now, the thing is, Institute over here has given you two alternative treatments for dividend. What are the possibilities, sir? The first possibility is that the dividend is declared after the year end and hence no effect is given. That is what we have solved. Even the institute has given the main solution like this. Even in question 33 and in the older materials, the data was like this. However, what if it was given that the dividend is declared before the year end? It is approved, but it is not paid. That is alternative 2. Another alternative that the institute has done. Or what if the dividend is declared and also paid up to the balance sheet date? Now, in this question, it is silent and hence you can assume anything. However, what if the question told you specifically that you have to take the effects for dividend, assuming it is declared but not paid, or it is declared and paid both? So, this is what I would say is important, and also the treatment of capital reserve in this particular question is important. These are the two things. Okay. So, let us say in this particular case, we will look at if dividend is declared but not paid. Now, let the dividend be declared. What is the entry? What is the adjustment for dividend? 10% dividends were declared by both H and S, whereas A declared 15% dividend for the year ended 31st March 24. Now, if I had declared the dividend in the books of H, my journal entry would be I will debit the profits. So, ultimately, your profits, which is there in working note number 1, will be debited. Ideally, it will be the profits of H, but let us say for the timing, profits of H are sitting inside working note 1. So, consolidated earnings account debit to, let us say, dividend payable. I have given you all the entries in your board notes to dividend payable. Now, how much is the dividend? 5 lakhs was the share capital into 10% and hence 50,000. Now, you have no choice but to pay this dividend, and hence in my final balance sheet, if the dividend is not yet paid, it will be shown as a dividend payable. And this is payable to the shareholders of the parent, so there is no intercompany transactions over here. So when you look at this, we will say for adjusting entries, for H dividend will be consolidated retained earnings account debit 50,000 to dividend payable 50,000. So in my final balance sheet, there will be a dividend payable which will come at 50,000 to start with. Apart from that, whatever was my working note 1 balance, if I am not wrong, it was total 11,10,600, all said and done. That will reduce by 50,000. So you can see other equity 11,10,600 minus this 50,000 will come to 10,60,600. Further, a dividend payable will appear, which I have to pay, and this will appear at 50,000. Perfect. Now this is dividend payable by H. It goes to the shareholders of H. But when S pays the dividend, S, let us say, has your total share capital of S, for example, is 2 lakhs. Institute has also taken 2 lakhs and hence we are solving it accordingly. So, let us say that total share capital of S is 2 lakhs and 2 lakhs into, for example, 10% if I go to C, this will be 20,000. Now, the entry ideally would be in the books of S, there will be a dividend payable. So, to dividend payable 20,000, but to whom is the dividend going to be paid? Well, 70% of the dividend, that is 20,000 to 70%, 14,000 will go to the parent. So, in the books of the parent, there will be a dividend receivable. In the books of the subsidiary, there is a dividend payable. It is intercompany, will knock off. However, the remaining 30%, that is 6,000, is payable to the NCI. And hence, if I go to see the effective entry at the consolidated level will be, there will be a liability, dividend payable to the tune of 20,000. There will be a receivable, at least by H, that is a parent, to the tune of 14,000. And the remaining 6,000 is to be paid to the NCI. So, NCI to that extent will be debited because I am clearing off NCI's dues. Earlier I was saying NCI will get interest in the net assets. Now, it has a contractually enforceable amount that it can receive. So, NCI will be debited by 6,000. So, 14,000 is receivable and payable and hence this will be knocked off. 14,000 intercompany, dividend receivable and payable is to be eliminated and hence dividend payable debit 14 to dividend receivable 14. There will be no effect of this 14, but NCI debit of 6,000 will continue and a payable that the group has to the NCI, that is subsidiary which is a part of the group, has to the NCI will remain. So, ultimately the net effect is NCI is falling by 6, and the dividend payable is increasing by 6,000. So over here, as you can see, your NCI will be 2,85,000 minus 6,000, and S has to pay this amount, that is 6,000. Remember, you are consolidating parent and the subsidiary. You are not consolidating associate, you are just showing the investment in the associate. Now, if associate declares a dividend, that is a liability for the associate, not the liability for the group. So, the associate would say that I had earned a profits, if I am not wrong, of around 2,49,000. Now, I want to declare a 15% dividend. My share capital was around, I think, 1 lakh. 1 lakh into 15% will come to around 15,000 will be my dividend, but this is dividend paid to everyone. Dividend paid to everyone, out of which 40% will move to the parent, and hence parent's share in this dividend is going to be 15,000 into 40%, that is 6,000. Have I received it? Well, not yet, and hence I'll show a dividend receivable. So dividend receivable will appear in the group's books at around 6,000. However, in my associate, earlier I was showing my profits at around 2,49,000. Now, if dividend was paid, this dividend would have been, let us say, less 15,000. If this dividend would have been 15,000, 2,49,000 minus 15, this would have come to around 2,34,000, and 2,34,000 into 40% would come to around 93,600. Basically, the carrying value of investment will reduce by 6,000. Sir, why? Because earlier I was telling that I had to recover 99,600. Now, out of that, the associate has committed to give me 6,000, and hence I am still yet to recover 93,600. So basically, as you can see over here, dividend receivable will be debited by 6,000, because for the group as a whole, associate is separate. It is parent and subsidiary is one and the same, associate is not one and the same, and hence 6,000 is the receivable. So dividend receivable will come at 6,000, and then I will not create a dividend payable liability, because associates liabilities are its own liabilities, not the group's liabilities. But my investment, which was earlier appearing at 2,05,600, which included 99,600, my share of the undistributed profits, out of which some profits have been agreed to be distributed, and hence this will be only adjusted by 93,600 instead of 99,600, and hence investment will be credited by this 6,000. So if I go to see, my dividend receivable in my balance sheet will increase by 6,000, and investment in A will reduce by 6,000. That's about it. Everything else, including cash, will remain the same. Sir, but cash, well, it has not yet been paid. Dividend is declared but not paid, and hence your overall cash balance for everyone, parent, subsidiary, everyone continues to remain the same. There is no impact. So the only changes, if I were to quickly sum up the changes in case dividend is declared but not paid, if it comes in the exam, is in case of a parent. Listen to this very carefully. This is the most important part in my understanding. If such a solution question comes, if dividend is declared by the parent but not paid, then there will be a dividend payable liability for the entire dividend amount, and you will debit the profits in your working note number 1, because your profits will be to that extent lower. Second, if there is a dividend declared by the subsidiary but not yet paid, then some part of this dividend will go to the parent, and hence the part of dividend payable and the part of dividend receivable by the parent will internally knock off each other. However, the subsidiaries due to the NCI will still continue as a liability, and hence I will show that separately as a dividend payable outside the group, and NCI will be debited to that extent. That is the second effect. Net impact is your NCI will reduce, and the dividend payable to the NCI will be shown separately if subsidiary gave the dividend. And third, if the associate is going to declare the dividend, it is not the liability for the group. However, I am going to receive the dividend, so I will book a dividend receivable. At the same time, in my associate, my share in profit to be added will be just the undistributed profit after deducting the dividend. So my dividend receivable will be shown separately in the balance sheet, and my investment in associate will proportionately reduce. I hope this is clear. If not, you can just review these notes where we have given a few adjusting entries for H dividend, and for O dividend, and for A dividend to the extent it is required. And then last part, if the dividend is declared and paid. Well, if it is declared, your entry is still going to be the same. For parent, it is going to be profits are going to be debited, consolidated earnings account debit, which we are still going to debit 50,000 to what? Well, instead of dividend payable, there will be two bank. Okay. So instead of showing 50,000 as a dividend payable, I will show 50,000 as a reduction from bank. Perfect. Secondly, for the subsidiary as well, 20,000 is going to be paid. Well, if it is paid, 20,000 is going to be paid, 14,000 is received. So you will reduce your overall cash by 20 and increase the cash by 14, and hence the net impact is your net cash for the group is going to fall by 6,000. 20,000 reduction. When you paid the dividend, 14,000 increase when you received the dividend, but 6,000 went outside the group. So your cash will reduce by 6,000. So instead of showing a separate dividend payable of 50,000 and 6,000, it is 56,000. This 50 and 6 will net be reduced from cash. Okay, sir, we are also receiving dividend. We are receiving 14, but we are paying 20 and hence net 6. We are net paying from the associate. If associate paid the dividend, associate's cash balance is not consolidated, but then 6,000 we received, and hence instead of showing a dividend receivable, I will add 6,000 to my cash account. So my investment in associate, my other equity, my NCI, everything will remain the same as this alternative, that is dividend declared but not paid. However, instead of showing a separate dividend payable and instead of showing a separate dividend receivable, the adjustments will be done in the cash account. So over here, what you will see is, see, this investment is 1,19,600. Over here also it will be 1,19,600, 99,600. Your cash balance was 187. Now the problem is 187 was parent plus subsidiary. However, now parent would have paid 50,000. So from this 187, I will probably subtract 50,000 because that is a parent dividend. Further, I will receive 6,000 from the associate. So I will add this 6,000 from the associate. Next, I mean, I've done this directly net 6,000, or you can show minus 20, that is paid by the subsidiary, plus 14, that is received by the parent, that is net 6,000, and hence over here 1,37,000 will appear. Further, there would be no separate dividend receivable, there would be no separate dividend payable because it has been paid / received as the case may be. Now, this, I guess, from an exam perspective is a fairly compact discussion, and hope this is helpful for you. The two things that you need to revise when you do this question is the impact of the three types of dividend, and secondly, what if there is a capital reserve in case of an associate? That is, in such a case, capital reserve has to be shown separately as per para 32 or 33 of Ind AS 28. Capital reserve has to be shown separately. Goodwill is merely to be disclosed. This is given as per the specific Ind AS principles. I'll share this board notes on the Telegram channel. You can take it from there in case you are comfortable with this format. Otherwise, Institute has done it in its own way. The ultimate impact in the balance sheet everywhere, even if you see the Institute solutions, remains the same. This is 29,10,000, 29,90,100. To start with, it is 2,05,600. Later, they have prepared a separate balance sheet again, 1,99,600, and all of this. You can review it separately if the need be. Okay. I hope this video has been helpful. I'll see you soon with some more videos. Till then, keep studying. Good luck. Take care and keep confidence on yourself. You will do really great.